Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of McDonald's Corporation, ticker symbol MCD. We're looking at McDonald's today because they have consecutively increased their dividend payments for each of the past 45 years, meaning that they are a dividend aristocrat. So dividend aristocrats are companies that have increased their dividend payments consecutively for 25 years and are members of the S&P 500. McDonald's is only 5 years away from becoming a dividend king. Dividend kings have increased their dividend payments for each of the past 50 years and again are members of the S&P 500. We're checking out McDonald's and looking at their fundamentals to see if the company has what it takes to potentially become a future dividend king, where it would join the likes of companies such as Johnson & Johnson, Coca-Cola, and Procter & Gamble. Also looking at McDonald's today because the health of their food aside, who doesn't love the golden arches? So currently McDonald's is trading for $254.55 per share. Over the past year, their stock price is up about 6%. Going back 5 years, McDonald's has compounded at a rate of 8.5% annually. Over 10 years, they're compounding at a rate of about 11% annually. And going back prior to the global financial crisis, over the past 18 years, McDonald's has compounded at a rate of about 12% annually. Keep in mind that this is not including their dividend yield. Currently, they have a 2.16% dividend yield. So McDonald's is trading in between their 52-week high and their 52-week low. They're a little closer to their 52-week high. McDonald's is a very large, very well-known business. They have a $187 billion market cap. So for additional background about the company, McDonald's is the largest restaurant owner-operator in the world, with 2021 system sales of $112 billion across more than 40,000 stores and 119 countries. McDonald's pioneered the franchise model, building its impressive footprint through partnerships with independent restaurant franchisees around the world. The firm earns more than 60% of its revenue from franchise royalty fees and lease payments, with the remainder coming from company-operated stores across its three core segments: the United States, internationally operated markets, and international developmental/licensed markets. McDonald's owned 55% of the real estate and 80% of the buildings in its franchise system as of the end of 2021, offering it substantial leverage in maintaining quality standards and consistency. So McDonald's Corporation was founded in 1940 and is based in Chicago, Illinois. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of McDonald's Corporation based off of their business fundamentals. This analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So there are 2 reasons for this. The first is that the average publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. So by looking for 14% or higher, we can potentially build in some margin of safety for ourselves based on the overall quality of the business being at least twice as good as average. McDonald's has earned pretty high returns on capital throughout this time. The lowest they got to was just under 16% in 2020. Over the last 12 months, they're producing 23% returns on capital. Averaged out over this time, while their returns have come down somewhat since 2018, McDonald's is still averaging 24.5% returns on capital. That's more than 3 times better than average and 1.5 times better than the metric we were looking for. This is a check to start off on metric number 1. Next up, for metric number 2, we're taking a high-level overview of the cash coming into the business. We want their revenues, net incomes, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. So over this time, their revenues are up just a little bit. Their net incomes are also up by more than $2 billion, and their free cash flows are just under doubling over the last 5 years. While the business did see declines in 2020 during the COVID-19 pandemic lockdowns, the company has rebounded strongly. They're doing better now than they were pre-COVID-19 pandemic. All 3 of these are up, so this is another check here on metric number 2. For metric number 3, we're looking at the business from the perspective of an individual shareholder in the company by looking at McDonald's on a per-share basis. We want their earnings per share to have grown over the last 5 years. We saw in their previous metric that their earnings were up over this time. Their earnings per share are growing at a rate that's just a little bit faster than their earnings. So this clues us into the fact that McDonald's has been buying back shares over this time frame. So McDonald's has actually bought back about 8% of their shares outstanding, which is fantastic as a long-term shareholder in the business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that business. And when a business decreases the number of shares that they have outstanding, by buying back stock, they're increasing your ownership percentage in the business, which ultimately increases the percentage of the company's profits that you're entitled to without you having to spend a dime. So it's almost as if the company is making an acquisition of itself. So we want companies that are buying back shares when they're trading below their intrinsic value. So over this time, McDonald's has both increased their earnings and they've decreased their shares outstanding. So their earnings per share are up over the last 5 years. This is another check on metric number 3, and we are perfect 3 for 3 to start things off for McDonald's. Metric number 4 is going to be very similar. Here we're looking for 5-year free cash flow per share growth. Again, their free cash flows are up over this time and they bought back shares, so this is a check on metric number 4. Another thing to note that's looking good for McDonald's here is that over extended periods of time, meaning 10 plus years of data, we roughly want a company's earnings and free cash flows to be about the same. This is looking to be the case for McDonald's. This is indicative that on a cash flow conversion basis, the company is at least not using aggressive accounting here. So that's a good sign for the business. We're still perfect 4 for 4 through our first 4 metrics. Next up for metric number 5, typically here we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. For McDonald's, this metric is a little bit interesting because they own so much of their own real estate. Ticker does not break out what their mortgages obligations are. Instead, a lot of their real estate is going to be lumped under their long-term debt. So we're going to be comparing their long-term debt to their free cash flows. Last year, McDonald's had about $35.5 billion of long-term debt, and over the last 5 years, they produced $25 billion of free cash flow. So even though they have more debt than their free cash flows support, again, because of the specifics of McDonald's business, that a lot of this is probably their mortgage obligations that they have on all of their real estate assets. Even though technically it does look like the business is overly levered, their debt being mortgage obligations is likely structured in a way that's very advantageous for the business. You would just want to dig in and learn more about exactly how McDonald's long-term debt is structured to get more perspective of the business. Again, in all likelihood, without being an expert here, it would seem that McDonald's would be employing reasonable amounts of debt in their company, and that this high debt load would come from long-term real estate obligations. Then our 6th and final metric, the big metric of them all, we want their average free cash flows to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the risk-free rate of the 10-year treasury and give us a reason to potentially be interested in McDonald's. We're using their total enterprise value here because it's going to give us a more realistic picture of the business's economics by taking into account both their market cap and their net debt position. So currently, McDonald's has a $233 billion total enterprise value. We learned that over the last 5 years, they produced $25 billion of free cash flow, which means that they're producing about $5 billion of free cash flow in a given year. So when we divide their $5 billion of average free cash flow by their $233 billion total enterprise value, that only gives us an average free cash flow to enterprise value yield of 2.1%. So that's about half the rate of the 10-year treasury currently, and that's well below that 5% mark we're looking for. So this is going to be another X on metric number 6. Also, to run the numbers, over their last 12 months, they produced $6 billion of free cash flow. So to get a current free cash flow to enterprise value yield, when we divide their $6 billion of last 12 months of free cash flow by their $233 billion total enterprise value, that only gives us a 2.6% current free cash flow to enterprise value yield here. Both on a current and average basis, it looks like McDonald's are less than that of the 10-year treasury rate. So it looks like the quality of the business that's reflected in their nice returns on capital and some of the qualitative aspects of the company are being appropriately priced in here, generally speaking. Then here we're taking a look at McDonald's dividend profile. So again, McDonald's has a 2.16% dividend yield, which is higher than that of an S&P 500 ETF, and they paid out increasing dividends for each of the past 45 years. So it's really easy to make mistakes by blindly chasing dividend yield or dividend track record. So it's important that you stop and you consider the underlying fundamentals of a business by looking to see if a company can support their dividends with either their earnings or their cash flows, depending on the business. It looks like although they paid out a pretty high percentage of their cash flows as dividends in some of these years, more recently in 2021 and over 2022, McDonald's has been producing a lot of free cash flow and been able to pretty comfortably support their dividend yield. Given the track record and the quality of the business, it would likely seem that McDonald's would be a pretty good candidate for becoming a future dividend king. Again, past performance is no guarantee of what the future has in store, but McDonald's dividend profile looks like it's healthy. Then finally, here we're using a discounted cash flow model to come to a potential fair value for McDonald's. So starting with their current free cash flows and then projecting both growth and terminal stages based off McDonald's historical abilities to grow their free cash flows. So using a growth stage over the next 10 years with a growth rate of 8.5%, which dating back over 30 years, that's how McDonald's has grown their free cash flows historically. Then assuming in a terminal growth stage over the next 10 years, so projecting 20 years out in the future in total, where that growth rate falls by more than half to only 4% annually. Then based off of those assumptions, which you need to do your own homework on to understand if those are going to be applicable to help give an estimate of a baseline projection going forward for McDonald's into the future, that if you wanted a 10% rate of return from McDonald's, a fair value for the company would be about $126 per share. That is quite a bit away from where McDonald's is currently, sitting at about $255 per share. So using those same historical growth assumptions from McDonald's, at today's prices, it looks like the company would only be returning a little under 3% annually over the next 20 years. Keep in mind that this rate of return would be including the company's dividend payments, and currently they're paying out more than 2% yield here. Also, we're not using their tangible book value because that's skewed by the accounting that's used for McDonald's buybacks over the years. At any rate, it looks like the quality of the business is being pretty well priced in here. However, keep in mind that this type of analysis is not financial advice. It is not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, McDonald's checks the box on 4 out of 6 of our metrics. They're a dividend aristocrat who have consecutively increased their dividend payments for the last 45 years. Looking at their dividend profile, it looks like they'd be a pretty solid contender to become a dividend king, as their dividend payments have been well supported by their cash flows in the majority of these years, and that's been especially the case recently. On an average basis, the company is earning very high returns on capital that are about 3 to 4 times better than that of average. Over the past 5 years, they've managed to grow their revenues, earnings, and free cash flows, and they've repurchased about 8% of their shares outstanding, so their per share metrics are up as well. Then because of the unique structure of McDonald's as a business, with them owning so much of their own real estate, that's lumped into their long-term debt, which is part of the way that Ticker calculates their net debt. So even though that was an X for us, in all likelihood, doing further research into McDonald's would probably reveal that the company is about appropriately levered. Again, the way you can confirm that for sure is by reading through the company's 10K. Then also by looking at their average and their current free cash flow to enterprise value yields. McDonald's does not look like it's giving us a very attractive yield relative to the 10-year treasury, coming in at just over 2 and 2.5% respectively, which is below where the 10-year treasury is at right now at about 4%. Then finally, performing a discounted cash flow analysis of McDonald's based off of their historical abilities to grow their free cash flows, which are assumptions that you need to determine for yourself whether those are accurate and applicable for McDonald's going forward. That from today's prices, it looks like you could only expect a little under a 3% rate of return from McDonald's, and that 2% of that rate of return would be eaten up by the company's dividend. So it looks like their share price could potentially be flat for a decent while to come here. Again, this entire analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed financial advisors. This analysis instead serves as a beginning and holistic understanding of the McDonald's Corporation to help you determine whether it's worth the time and energy to dig in and learn more about the business in more depth. If you're interested in learning more about McDonald's, I recommend that you start with the company's filings, so you can check out their 10K to get a sense of the history of the company as well as and to check out their operating results. Management will also lay out some of the potential risks that the company faces, and you'll get a sense of both the strategy and the capital allocation approach going forward from management, which will help you to determine both the character and the competence of management. From there, I'd also recommend that you read through the company's 10Qs as well as some of their recent quarterly earnings call transcripts. If you're interested in learning about the business even more, Ray Kroc, the man who really popularized McDonald's and really created the franchise system for the business, wrote a book called Grinding It Out, The Making of McDonald's that's worth a read. And there's also a dramatized movie of the events that took place concerning McDonald's expansion across the United States called The Founder. So if you're interested in a good read or some entertainment by watching the movie, those are two additional resources you can check out. Ultimately, as a value investor, your goal is to understand a business as if you're going to own 100% of it, and you can truly understand the essence of the business. So all of this deeper research will help you learn more about the qualitative and the quantitative aspects of McDonald's to help you determine for yourself what you think an appropriate intrinsic value for the company should be. So with that said, that's it for today's fundamental stock analysis of McDonald's Corporation, ticker symbol MCD. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about McDonald's with me, and have a great day.